We've heard a lot about 250 years of fund brief history. We've heard about highest standards being set by that product. We all know it's a success story through good and bad, and we also realize that the covered bond market probably has never been as global as it is today. So we try to understand what this global trend is about, what are drivers, what are potential limitations, and where we stand. Luca also mentioned, I think earlier on, we would want to give a specific spotlight on the Brazilian market and the Japanese market. So I'm very happy that we have experts being able, obviously, to share some first-hand information. And having said that, I'm glad to introduce my panelists, or ask my panelists to introduce themselves. I think a great lineup. We have three issuers. We have a Covered Bond Association, we have a rating agency, and we have the World Bank. So I think we should be able to deal with most of the questions coming up. Carsten, if I may ask you to start, obviously on home turf, so to speak, with a quick introduction, and then we'll take it from there.
Yeah, very welcome this morning. Thanks for having us here. My name is Carsten Tegtmeier. This is not my home turf. I'm not Bavarian. I'm coming from the north of Germany. I'm working for Norddeutsche Landesbank. We are an issuer of Pfandbriefe, of course, and I'm responsible for the DCM business, which includes, in our case, the funding via all kinds of Pfandbrief, asset-backed, and anything instruments.
Antonio Farina, I'm an analyst in the covered bond team at S&P Global Ratings, and I cover new markets.
Hey, morning, my name is Colin Chen. I'm chairman of the Global Issues Working Group at the ECBC. I'm also representing the Singapore banks as the chairman of the Covered Bond Committee at the Association of Banks in Singapore. In my day job, I work at DBS Bank and I run securitization and covered bond restructuring.
Just for the sake of it, obviously I have a day-to-day job as well, heading primary markets business at Landesbank Baden-Württemberg in Stuttgart. Filipe, back over.
Hi, I'm Filipe Pontual from ABECIP, which is the Brazilian Mortgage Banks Association. I'm a managing director there, and we've been pushing to adopt in Brazil the covered bond for quite a while now.
Good morning. My name is Atsushi Ouchiyama. I'm treasury of the Sumitomo Mitsui Banking Corporation, one of the three largest mega banks out of Japan.
Good morning, guten Morgen. Loïc, Chiquier, thank you very much for inviting me again. I represent the World Bank. I'm a senior advisor to the general management, and particularly in charge of long-term finance globally in emerging countries, which covers capital markets, pension funds, insurance, infrastructure finance, and housing finance. Thank you very much.
Great. 250 years. Carsten, I'll have to invite you to maybe make a first comment. What does that historic moment mean to you as an issuer, issuing in Pfandbrief format mostly?
Well, first of all, it's a very important date for us. Unfortunately, I have to say the Pfandbrief market is 4 years younger than our bank. So we have been founded in 1765, means we are quite long in this market. And of course, we have been an issuer in this market also to a very early stage. And since that, the Pfandbrief has been very important for not only the bank itself, but also for the whole group. And I think we have benefited a lot of that very safe instrument, especially since the financial crisis a couple of years ago. And I think it's also important, and we will, I think, highlight that a little bit later on, the development that we started with the Pfandbrief. Now we have a European Covered Bond Council, but maybe European Covered Bond Council is too small, because meanwhile, it's a worldwide product.
We had that proposal yesterday. There's plenty of room, obviously, to expand the discussion and maybe go into the benefits of Pfandbrief issuance also at a later stage of the discussion. Colin, you being a somewhat more recent issuer in covered bonds, let's say, do you relate to the same extent to, let's say, that success story of the Pfandbrief or the covered bond?
Well, it's nice to know that I'm no longer the youngest entrant to the covered bond community. I think, Singapore has been here for 7 years. And the Pfandbrief has led very much the way. And through the community of what we call candidly as a covered bond village, we have endeavored to try and build a bridge using the knowledge that has been shared with new jurisdictions. So in terms of legislation, in terms of the structure in terms of the covered bond product, I think from a Singapore perspective, we are here to preserve as much of the integrity of the original intent of the product. And as the Global Issues Working Group, what we do is to ensure that new countries that come on stream also preserve that premium of the fund brief and therefore the covered bond product.
So it's a legacy as well that you...
I hope to be part of the future.
Okay, great. Atsushi, last but not least, also another, I would say, more recent name from Asia, but obviously under a different, I would say, preconditions, so to speak. What's the link that you have to the covered bond and the fund brief and that historic, let's say, track record, so to speak, of that instrument?
Sure. We issued, a Japanese bank issued our first ever covered bond last November. So our history is just 1 year old, baby. So my personal opinion, we are very happy to be part of the long history of the covered bond market. And I hope we can contribute to the covered bond market in terms of the liquidity from the third country.
If we go a bit more into details, I mean, you had 250 years to think about issuing covereds, or 249, technically speaking. Ultimately, you did it. Did you get what you were hoping for in terms of benefits for your good organization?
Yes, at least we could achieve the dual recourse and we could have the covered bond program and we could get the AAA rated product out of Japan. This is the only program at the moment. The foreign investor can invest in the Japanese exposure in the euro denominated or the US dollar denominated. So I think this is a huge benefit for the Japanese banking industry. So everybody within our institution is very happy with the achievement.
Do you feel it helped to issue in covered bond and to be able to build on the history of covered bonds when presenting your specific, which I think is contract law-based, let's say, issuance?
Of course, ideally, Japan would like to have a covered bond legislation in the future. So we relied on the contractual provision last year, but at the same time, we already started talking with the Japanese regulator how to implement the covered bond regulation. So actually, I visited Japanese FSA last week, and then we discussed what is the best way.
Still work in process.
Still work in progress, but I think it's a positive progress at the moment.
Cool.
But we cannot I cannot guarantee when and how, when. But
best effort. Fair enough. We'll conclude on that. Colin, obviously talking for DBS and also on behalf of the chairman of the Global Issuers Working Group. It's quite a obviously straightforward comparison talking about fund brief and then linking that to covered bond right away. But then we learned from Atsushi that there is many differences and small details that need to be dealt with and a lot of preparatory work. Do you feel now with those few years of track record already, you did obtain the benefits you were hoping for ultimately when you entered into that journey?
It was a journey indeed. I think for Singapore, as a AAA jurisdiction in a region that is pretty much triple B at best, we needed to come up with a product that is able to achieve that premium notion of a AAA product in a AAA jurisdiction. And what we then decided to do was to take all of the lessons of how the fund brief and the European covered bond product should be. And I mean, I'm happy to say that if not for the fact that Singapore sits on a tiny island in the Far East, we would pretty much be an accepted European covered bond product. So that was how we created the Singapore product. As to whether it's achieved its intent, I think we have achieved more than what we had expected to achieve from the onset. We've opened up the conversations with new investors who would not ordinarily look at Singapore or Singapore issued product. And the covered bond instrument was the only instrument that some of the investors here would look at. Conversely, what we've also progressed is that Singapore or Asian institutions now are also buyers of European products. So, we are seeing an exchange and a creation of an ecosystem that I think we are very happy to be part of.
Obviously, we want that reality check with Carsten as a fund brief issuer. You mentioned that the tool has been fairly relevant after the financial crisis specifically. Would you want to share a few more details how relevant covered bonds are specifically to your group? I understand you are issuing also in various formats. How does that basically work?
Now, basically, we are issuing the different, let's say, styles of fund briefs. That means we are in the public sector fund brief. That is where we ourselves are the issuer. Besides that, we are covering the typical mortgage fund brief business, which is done by our Deutsche Hypothekenbank. And on top of that, we have an issuer in Luxembourg, which is covering the letter de gage market. So that means these are the three, let's say, roughly frameworks under whom we are issuing. And again, the importance is, especially in difficult times, of course, when you need some funding and let's say the senior market is probably not open, or maybe it's too expensive, or longer term maturities are not available, then of course it's good to have sufficient in the cover pool to access that market, because even in bad times, which we all have faced a couple of years ago, this market has always worked.
How much harmonization is there between these three programs?
Well, of course, we are looking on the asset side. There is a very strict guideline. That means everything which is public sector is done by us. Everything which is the typical mortgage is done by Deutsche Hypothekenbank. And so to see all those assets which under the German fund brief law are not collateral anymore, these are the instruments which we are shifting to Luxembourg, where the Luxembourg law allows to issue the letter de gage against it.
Okay, fairly stringent. Let's see what the rating agency's view to that is. Do you share the comments we've heard from well-established, long-time issuers, somewhat more newcomers maybe to the market? How vital for you as a rating agency is the covered bond in the funding mix of a bank?
Well, we agree that it's very important, and I hear that from established issuer as a funding tool for a rainy day. It's even more important for issuer in maybe Southern Europe, where we really have experience, where during the debt crisis it was very challenging, probably much challenging than for you guys to issue anything than cover a bond. So indeed, it's an important component for deciding whether or not to use these instruments. And it's been tested, and it works fine, and probably is one reason to think that other jurisdictions are also introducing covered bonds. And when you guys started the journey in Singapore, it was a question: why do you need covered bonds at all? But we're speaking with the Monetary Authority of Singapore. They're saying, yeah, we know that we have plenty of funding, but we want to have some funding that will work also when other instruments are not available. So generally, from a credit agency's point of view, we think that the issuance of covered bond generally is beneficial, not just for the senior secure instrument, but generally the fact that the bank has an additional source of funding is seen as something positive for their credit profile.
If I may insist on that, do you make a difference whether covered bonds are being sold to the broader market or if they're just issued and retained, basically?
Well, usually, and again, when we look at covered bond being an available source of funding and expanding the funding tool, it's obviously better to see that they can distribute to a wider investor base, because you know that today Monetary Authority, for example, can purchase covered bonds. We don't know if you will be there tomorrow, right? Probably yes, but
tomorrow
you cannot bet
day, yeah.
exactly tomorrow at 4 at 2. But yeah, it's better that from that point of view that there is an acceptance for a wider investor base to invest in covered bonds.
All right, so that I think is Loïc's an entry card, so to speak, to the discussion. I mean, plenty of good reasons to do it. I think the World Bank and you personally are putting in tremendous work in helping countries to set up the necessary infrastructure. Do you equally share the comments we've heard about? What's your take on how relevant the covered bond is in potentially also addressing some of the socio-economic topics we've heard about in the presentations earlier on by DBRS?
Yeah, from a point of view of financial long-term finance inclusion and stability, we appreciate very much the use of covered bonds in more legislations. It helps to diversify funding sources, to mobilize capital markets. So it's very well appreciated. Now, the big trends in most countries out of Europe is growth of mortgage market, right? And more fixed real rate or fixed nominal rates. There's always a moment where the usual traditional model of a deposit transformation comes to a limit. Some countries have not yet there, some are reaching that. So for example, if a country not represented today like Morocco is interested by that, two main fundamental reasons. I pick that as an example, right? We're not going to list 190 countries today this morning. Two reasons. The mortgage market, its fixed rate, has reached about 13-14% of GDP. There's a moment where the regulator and the banks would like to use more bond markets, not just transform deposit, right? And they're all fixed rate. So there's real interest rate, risk to manage there, with a considerable interest on pension funds. The second reason is sub-sovereign. I didn't hear much today, but there are more countries which are really decentralizing in the process and giving to local governments more authority, more investment, more fiscal resources. And such local governments would like to use more public Pfandbriefe. So if the use of public Pfandbriefe is going down in Europe, probably as I've seen this morning, it could be a potential to grow in some other countries. So two reasons, right? I picked this example. So we
Is some kind of a catch-up story in some way, you would say?
I'm sorry?
Means catch-up related to the level of maturity of, let's say, the core European economies versus the
Yes,
emerging markets?
I'm just saying some other countries in Africa, in MENA, in Latin America, and Asia have a need of long-term local currency, long-term fixed rate funding. So they need to diversify the pool. The cover bond's interesting. From our point of view, it's a global market from investor side, right? It was not necessarily yet a global market from the issuer side. It's mostly Europe. But if you see what's on this panel is a testimony, what's happening, you have more and more countries out of Europe issuing now, right? And there's some, of course, yield opportunity now for investors to look for cover bonds elsewhere. So it's not by chance we will hear, about Brazil case, but even in Latin America, Brazil joined the club recently. But you also have Chile, Panama. We see Singapore. We have interest expressed on Japan testing. We have seen interest also expressed by South Korea. We are asked questions from Indonesia now. I'm going to lead a mission next week in Georgia. So there are a lot of countries interested. The caveat is there are some preconditions. I think the chairman told us this morning, innovation and tradition. So this is a challenge to go from Europe to global. We have to respect the best principles, and the directive for us is key as representing the principle-based, the best, while adjusting to different global markets, right? And some markets do not necessarily have some of the minimum precondition. I'll come back to that later, maybe.
Okay. You've obviously mentioned, kind of between the lines and then explicitly some of them markets that are working very hard already with your support in implementing covered bonds. Do you recall any example which went terribly wrong and where you believe that even the benefits of the covered bond were never really understood by local authorities and governments?
Oh, let me avoid being undiplomatic here and putting names of countries. It would not be terribly smart on my part as a World Bank representative. But clearly some wasted effort, but the same could be done, said about securitization. Tons of countries try to push for mortgage-backed securities. Well, when you develop second mortgage market, on-balance sheet or off-balance sheet, cover bond or MBS, one precondition, you need sizable, standardized primary mortgage markets. It looks obvious, but you will not believe the number of countries which have not reached this point. you issue cover bonds in Poland, in Turkey, or other places because you have reached a point where the mortgage market is already standardized and reaches in size. A bank cannot go to the cover bond market with a very tiny portfolio, right? So that's one of the preconditions which was not sometimes not respected. Also, a lot of countries also try to do a structural cover bonds where it came shaky, what it was, right? And when it was stress tested, it didn't go very well. So there's a moment where countries also came to the conclusion we may need to go the long, painful legislative way if we want to do it really and reassure global investors, both national and global investors. But no, I've ducked your question. I'm not going to name a list of
okay, maybe later over drink or over lunch on a bilateral basis, but at least you seem to suggest, and I hope we agree on that, no real shortcuts, which wouldn't be surprising because if you defend a high standard, well, you have to put some serious work into it. Maybe to conclude on that, upcoming supply, if I may call it this way, I think the covered bond market this year in euro terms is, I think, to the tune of 140 billion or so. What would you expect from those new markets within the next, 2-3 years? Is this material, you think, or is it going to be something more of a slow start or like a major game changer, so to speak, in terms of new jurisdictions coming to the market?
I'm not going to play the guru yet this morning, but I think the European directive is going to play a big role. It's going to be splash of visibility of best principles. Tons of our client countries are asking us about what to do with that. So it's going to raise the level of knowledge, and maybe ECBC will be a world WCBC in a few years because we see a considerable interest from more countries. So I think there will be a lot of tests and pilots, like in Japan, people interested to learn, to study, or even pilot. When you go to the legislative way, which is a painful way, for example, needed in India, it will take 2-3 years. So we have these 2-3 years of the equivalency, which is really very important. I think a lot of countries are going to use that. Does it going to translate in hundreds of billions of new issues in the next 2-3 years? No, I don't think so. But we can have a big jump after 3 years, or more countries using this time to prepare themselves. And I'm sure that Brazil would have scaled up by then, and we're going to see more of these examples. If I may use this opportunity to have the ECBC members, I'm going to challenge you, the public, 2 questions we have for you of a new type of issuers that you may not have in this room. If I may, 2 questions. We see things happening and maybe will come to cover bond world or not. One is a type of we assume one is room issuers would be commercial banks because that's a majority of ECBC membership, right? We see some countries like South Korea or India, where those which are really the large-scale mortgage lenders on who need cover bonds are non-banks, are financial companies regulated, but they're not traditional banks. So this will be a challenge for the community. How can we integrate in the future ECBC community non-banks? This is going to come, and we see that happening because that's a market reality in Asia and also in some countries in Latin America. The second group of new issuers are coming from more poor countries, emerging countries. The mortgage market is small. So you do not have a large bank with enough of a portfolio. What you see some centralized liquidity facility who issue bonds on the market to refinance different lenders, but they have the privilege of bankruptcy. So they fit the double matching principles, right? And these guys, they are in action in at least 7-8 countries now. I'm just going to list some of them. In West Africa, in Kenya, in Pakistan, in Nigeria, in Tanzania, and we start to build, and they issue bonds. One day or another, they're asking some of us to recognize their bonds as cover bonds. I'm just saying that I don't have the answers to this question. I just wanted to flag examples of non-traditional issues which are going to come to the world of cover bonds community.
As you said, it's coming, so it's about making potential choices, making the trade-off between critical mass that you need to have a somewhat of a liquid market, taking into consideration domestic, let's say, law as well, and then, knowing that a covered bond is not always exactly a fund brief. Anyway, Filipe, you've stayed quiet for way too long. We've heard hard work. You, without any doubt, have put hard work into, let's say, developing the covered bond market in Brazil. We'll get into the details a little later in the discussion, but just, let's say, in terms of benefits that we heard about, do you feel those have been achieved, are being understood? What role do covered bonds play in Brazil?
Yes, we went for the say, hard-working process of having a legislation passed. So ABECIP has been pushing for that since 2010. In 2012, the government hired or called a World Bank with Loïc team to go there and help the government think through how the region should look like, how it should work. I think we all, both the market and the authorities, were taking the long view that eventually this will be very necessary in the country to supplement the current, say, funding for mortgages. And from what I can see from what started happening in December when we first started issuing, is that things are going pretty well. I think the market is starting to...
For those who might not be aware of the details, can you just mention who's been issuing what?
Okay. We have 5 larger banks in the country. Of these, 3 are issuing, mostly private placements, basically, actually only private placements, because we're still waiting for the ruling by the Securities and Exchange Commission of Brazil for the public placement. It should come out by November or December this year. So it's been nice to do that way, because it was a way for banks to start testing their own systems, their controls. The fiduciary agent also learning this new role of being a fiduciary agent of a covered bond. Also, the depository, which is the B3 in the country, in Brazil, which is the stock exchange. They also have an arm that does the registration and depositing of the securities. So everybody's learning how to do this. And so right now we placed, these 3 banks placed something like close to 2 billion euros in covered bonds local, 3-year bullet.
Okay. Can you name the banks?
It's Itaú, Santander, and Bradesco.
Okay. Some familiar names, some obviously very domestic, but strong names too.
We are waiting for the largest one in mortgage in Brazil, which is Caixa, which is 100% owned by the Treasury.
Holding them back?
Public bank takes longer to do things.
Thanks for reminding me. Okay, we've talked a lot about structure and safety and top quality of the product. Let's maybe spend a word on pricing. I could imagine that Carsten has maybe an ambiguous view on how good the current spreads are, but let's say overall, has QE done good or bad to the covered bond market or Pfandbrief market?
Well, unfortunately, there is now a couple of maybe critical remarks. First of all, the market, the overall covered bond market in the world is fantastic for investors, and my view is the more issuers are coming, the better it is for the market. And of course, what we mentioned is you need a framework or guidelines or a label or minimum standards, and then everything goes forward. If we talk about QE, especially in the German Pfandbrief market, the ECB is an important player, of course. Unfortunately, I see them as a non-real money account. And at the end of the day, we are now in the Pfandbrief market in Germany by far in the negative territory. And what I'm seeing is that more and more real money accounts, long-term investors are not participating in the issues anymore because they say it doesn't make any sense for me in my business model on the other side. So that means what you see is central banks, what you see is treasury accounts. And of course, if the ECB continues QE, then I would not exclude that rate spreads will go down further, pushing more real money accounts out of the market. And what we should not forget, transparency is one of the main pillars of this market. Also, of course, the security of the product as such, but on the other side, also secondary market liquidity. And the further we come into the negative territory, and if we might face a setback one day, or some investors say, well, my performance is fantastic, I want to get rid of that stuff now, even in bigger lots. I'm not sure whether the secondary market liquidity on levels where we are right now is the same like we have, or like we were used to it, let's say 2 or 3 years ago.
Okay, fair point. And obviously normalization of interest rates is not on the agenda for now, at least. Antonio, maybe from a rating agency point of view, you could obviously make a case about, the cheaper the funding, the better, for the overall business model, to the extent that it has benefits in on-lending. What's your view? Is it, the same across the covered bond market globally? Do you feel the QE is impacting certain countries more than it potentially should?
Well, yes. Let's say a couple of things. QE has been beneficial, especially for some countries that were under immense pressure a few years ago. We were discussing whether they would repay their liabilities in euro or in drachma. So on the short term, it has been good, and the problem is for how long it will stay, because eventually will it hit on bank profitability. So there will be a moment where, from a credit perspective, rating agency perspective, too much of a good thing will become a bad thing. So we are waiting to see what the ECB will decide. But it seems that the trend is to postpone the normalization of monetary policy, and this in medium term could put some pressure on bank rating. If we look at covered bond more specifically, when interest rates go down for a period of time, it's beneficial if we look at the required OC to achieve a certain rating, because especially if you have a fixed rate mortgage or fixed reset, you are able to fund your assets with cheaper liabilities. For a while, it is beneficial because you have more excess spread, but again, in the medium term, also the mortgage loans will reset at the lower rates. So it's only a short-term fix, really.
Okay, let's hope we get to deal with it in the long term as well. Colin, now you have all the choices. You do issue SDBs in dollar, in euro, other currencies potentially as well. Let's say, have you, felt any impact of the QE, or was it just in terms of more arbitrage funding making the euro market at times more attractive?
Well, I think from an Asia perspective, we have committed to be out issuing consistently in the euro markets. The bank has issued across multiple currencies, Australian dollar, euros, and US dollars. I think it brings into question the topic of equivalence. I think given that we're non-European and non-EEA, we don't have the benefit of preferential capital treatment. LCR is disadvantaged. We are low 2A. That contributes to the small basis differentials in terms of pricing. But other than that, we are committed to issue at market level.
Okay, fair point. Let's see if Atsushi has the same view. And maybe you can spend a word as well on the interest of really understanding what your bank has been able to achieve, why exactly you have set up that covered bond program, and how do you use it for your good bank's purposes?
Yeah, our motivation is a little bit different from a traditional fund brief, because in Japan, plenty of Japanese yen in the market, and our loan to deposit ratio, general banking system overall, loan to deposit ratio is 60%. So we don't need cover bond to fund, our mortgage.
It's fun, isn't it? Covered bonds is fun. That's
yes, it's fun, of course. That why we explore the cover bond is because Japanese banking system is expanding the overseas business, European business and the US business and the Asian business. So our case, compared to the pre-crisis, our overseas book is five times big, larger than pre-crisis. So now SMBC, we have a $400 billion equivalent of the overseas asset. And then it's expanding 5 to 10%. So stability, going back to the previous topic, stability of the funding is the business challenge for the Japanese banking industry. So from that point of view, cover bond is very, very important. And Japanese banking industry is really interested in this resilient funding too.
Very interesting case, obviously, which basically means you use a European product or product with European roots to fund your European activity and not bring it back home, so to speak.
Yeah, we don't need any Japanese yen. So,
and you don't swap it back, right? You don't swap it back, you keep it.
No, all the fund raised by the cover bond, we transfer to the European business in the euro. So we have never swapped back into.
You said it's 400 billion business?
Yeah, 400.
I'm sure investors will have tried to nail you down on how much covered bond issuance that means.
Yeah, our collateral mortgage book is $100 billion equivalent.
Okay.
And we already issued within 1 year.
You will be busy over the next
billion.
couple of weeks and years, and
Yeah, we'll be busy. And some other banks out of Japan, we are looking at the cover bond, and I expect more issue out of Japan will come within 1 year time. So myself, annual issuance is 4 billion, and if we have like 3 or 4 issuers out of Japan, it's easily expected.
Makes it an important market without any doubt. Antonio, let's say covered bond directive. Is there something in this context that you feel is helping, supporting? Is it just framing quality that's more or less already there and relied upon?
Sure. Well, I guess that the first important thing is it didn't harm a product that was working. I think that this was important because a directive that would impose too strict guidelines on asset or over-collateralization or liquidity requirements would probably hamper some existing and functioning covered bond market. So this is good. And generally, for established covered bond legislation in Europe, we don't see a lot of changes and a lot of surprises coming along with the implementation. If we need to name one country, probably Spain is where they have more homework to do to align to the legislation and where they could change more things.
But Austria? Another one?
As well. But you see that the framework in Spain is very unique, where you have the entire mortgage book that is pledging favor of covered bond note holder. And a few years ago, different government, different legislation put out a green paper where they even suggest a cap to the over-collateralization. It was a bit scaring. But let's say that they have some more homework to do, but probably we don't expect very bad news on established covered bond market. On the other side, for new entrants to the covered bond market, is definitely positive to have a blueprint to see the direction in terms of asset quality, generally over-collateralization, liquidity. But again, without being too strict in terms of the risk requirements, because we have seen after the fall of the Berlin Wall that a number of jurisdictions try probably to adapt the Pfandbrief Act to their own country without adjusting to the needs of the local investor, local issuer, and it didn't work out very well for some of them. Again, we don't name names, but we know that then down the road they have to update their existing legislation. So overall...
in conclusion, is it like the more established the jurisdiction is, the less impacted you are potentially by the covered bond directive?
Yes, we don't see that there will be a big impact. That probably is a good thing. And for new legislation, I think that we will have more benefit because, again, it will reestablish the process to introduce legislation.
We have to ask Colin, because Colin is the man for new jurisdictions. And I know you have put in work as well, so it deserves being recognized and shared in that audience.
Well, at the ECBC, at the Global Issues Working Group, we published a research on how global jurisdictions are faring based on the directive. I think if you do not have or have not seen, I'll make a publicity role, and please contact any of the ECBC staff for a copy of that. We've actually done 2 iterations, one on the draft directive last year and one on the final directive that's come out this year. And we've basically mapped new jurisdictions and existing jurisdictions in terms of the impact of the directive against their current legislation. So moving on and using that as a basis, it helps. For example, in Singapore, we've just commenced a review of the legislation. And with the directive and with the work of the GIWG and the ECBC, it helps and makes it easier for us when we map against the various articles. It is confusing for a non-European, but believe you me, it helps set the tone and sets the requirements, albeit that certain countries and certain jurisdictions, a direct mapping may not be relevant. And I think that's something that we hope, through the ECBC and the work of the ECBC, we can.
Is a 30 months implementation, is that short, long, too long, way too long, or?
Well, I guess the question at the implementation is that implementation is due to take next 2 years, I believe. And third country equivalents and conversations would only take place after implementation has been completed. That perhaps, I think if you ask my fellow panelists, I think might be perceived to be too long. And what we hope to do and what we are anticipating, Canada inclusive, ourselves in Singapore, is that we would commence our own internal in-country review of legislation so that we can, in parallel, try and expedite that process.
Fair enough. I'll get to Filipe. Obviously, we've heard to some extent what we can expect from other markets. Brazil is well known for various nice things, caipirinha and football players. Will it also be known for Brazilian covered bonds one day, equally famous, maybe?
I believe so.
I'll quote you on that.
Especially in the local markets. I think what we hear from the banks is that once the public placement regulation is there, we're going to see a lot of issuance locally next year. So, and expect that eventually this is also going to drive for international issuance. For example, we are increasing the mortgages in Brazil this year for 29 billion euros worth of mortgages, new mortgages. So the traditional funding definitely is not enough to push us through. For example, right now we have around 10% of mortgages over GDP. Chile has 22. There's no reason why we shouldn't be 15 or 20.
Do you feel the fact that covered bonds are possible now and will become a more established product has helped banks to increase lending, mortgage lending?
Right now, they do have some room within the traditional source of fundings, but for all of them are looking at mortgages as something, a driver of their growth in the country. So they will definitely lend much more if what we've seen today is we keep what we see there today, which is stability in inflation, stability in interest rates, so reforms going through Congress. So everything is there to actually try including new things, including now some are already started trying to land in the index to inflation, which is something that we didn't think of just a few years ago. Another thing that is important is that it helps the bank to better manage asset and liability, because the traditional source of funding can be called by investors at any moment. Albeit it's been very stable over the last many decades, it still is a short-term funding. So to better match ALM, covered bonds also is playing a part on that.
Very interesting. Again, to come back to the football, is it more Neymar style or more Pelé style?
More Pelé style.
I wasn't expecting anything else. Okay, I think we will slowly have to come to an end, but I will insist again once more, because Loïc has kind of, the overall view. So we've spent quite some time on Asia, on Brazil. We've not really talked about, let's say, Central Eastern European market that also have quite successfully made an entry into covered bonds. Poland to start with, Slovakia as well very recently. What's your view on, let's say, how the market will develop in the next couple of years, or what does it take to fully exploit that potential that we've touched upon various times, but we still hear that there is small bits and pieces that need to be worked upon. If there was that one ingredient that you could bring to the table, what would it be?
I think your question is multifolded. For Central Europe, it's a bit specific, right? We're speaking about Europe. So EBRD, my colleague EBRD have done wonderful, and are doing wonderful work, to update legislation and or write new legislations. Like in Bulgaria, I think you're going to work, but you help, Czech Republic and the Baltics, and this is very important because these markets belong to EU and they're growing fast, right? They're going very fast, and cover bonds should have an impact. So I think we should see a catch-up phase there, thanks to the recent or updated legislations. There's interest from investors. So then we have to go one granular. Maybe cases are very different from one country to another. Poland had a very spectacularly good start, right? With 4 issuers, if I'm not mistaken. I'm looking desperately for Jacek to correct me if I'm wrong, but I think it was 4 big issuers, very successful. But for example, in the case of Poland, the problem, and this is something I've seen in several countries, if there's a risk that the market will be domestically hampered because of the tax regime of bond markets. For long stories, not going into details, the banks have been taxed. But
tax is always a problem.
Yes, banks are very good praise for being taxed, except for treasuries, right? The whole treasury is tax exempted, but the whole corporate bonds or cover bonds, it's taxed. And that creates a huge premium, if you want, disadvantages. So Poland went for the model of specialized banks, as you know, mortgage banks. They're going to soon reach this limit where it will be very difficult for them. So some of these countries, Brazil may be hit by that because the bond market is very favorable for retail investors on the bond markets. If we don't change the tax regime between pension fund institutional investors and retail investors, this could be stumbling blocks, okay? In specific countries, if you want, could hamper the really large-scale development. But that's to some extent national, specific, normal issues to be solved through time, right? On the big thing, I think the big thing I would like to go what the chairman said this morning, right? Tradition, innovation. I mean, this is a market which has rebuilt a lot of tradition and solid tradition and best practice, reflected somehow in the directive, right? But the big challenge is going to go global. Global is going to be very different markets. Brazil is going to test ICPA, inflation index cover bonds, right? That's not something most of you have done, and in India it will be different, right? So there'll be a lot of challenges. How can we help this movement, this trend, to keep the best of the tradition for the cover bonds, but adapt it to markets which are very different? One good test, one thing to say, would be the working group and the task force working on the equivalence. It's not sufficient, but it's a precondition. And as one speaker said in the earlier panel this morning, it's just not to say, hey, under which conditions the Basel, the LCR ratio, we have to look also in our home country, the other country, do have the same treatment of our cover bonds in terms of risk weighting. There's a lot of work which would involve the regulators of all these countries. My beg is not wait for the last minute after the 3 years to start working on that, because it will be a big problem for Singapore, for Brazil, for Canada, or for other non-European investors, issuers, I'm sorry. So let's start the work as soon as possible.
Absolutely. I think that is a wonderful closing remark in a way, unless any one of you has a final word on ingredients, but maybe we're just all hungry and eager to rush to lunch. If we conclude, it's the obvious thing is Fritz 250 years ago probably would have been delighted by the success of this product. We've heard a lot around how vital it is as a funding tool, how robust and ideally better it makes the banks. It's being relied upon a lot, maybe too much in a way, also as a transmission mechanism for monetary policy. So that would be maybe a small reminder that we should not, let's say, overexploit the product in what it's supposed to serve. But it's also, let's say, that common language that allows investors to invest quite globally in markets that otherwise would be way more difficult, let's say, to understand. So we'll not get rid of differences. We probably don't want even, but they're well understood. I think the political relevance is well addressed, and I think the covered bond market is, let's say, an ideal market also to serve a lot of the challenging political agendas coming up, to just name sustainability as one of them. And having said that, I think, as you said, Loïc, a lot of work to be done. The ECBC, I think, has a vital role in there, and the whole community has been underlined various times in preparing that ground, developing that market further, while always safeguarding the top quality.
No, I'd like to just make a quick comment, which is, besides the World Bank, the ECBC was very, very important in helping us put together a very good, what I believe is a very good rule and legislation for the local covered bond there in Brazil.
There's credit, and the future starts now. Ladies and gentlemen, thank you for listening, and thank you to my panelists for their contribution.